If you own a home and want to buy another one of the first questions you're probably going to ask is, what do I do with the house I already own? Do I sell it? Can I keep it rented out? Can I use the equity without selling it? Do I buy the first house or do I need to figure out where I'm going to go first? And then somewhere in this conversation, almost everybody tells me the same thing. But Mike, I've got this 3% interest rate. And all of those things, and the interest rate does matter. But I think what makes the decision harder than it needs to be is because almost everybody starts with the interest rate first instead of looking at the entire financial picture. Hey, real estate friends, my name's Mike Gold with Remax Alliance. I sell homes in and across the greater Denver Boulder area, and I also run a property management company, as well as being an active real estate investor myself. So when someone comes to me with this question, I'm not just automatically going to get them to try to sell or buy another house. If keeping it as a rental makes sense, we can walk them through that. And more importantly, how to access the equity with inside the house in order to make this a viable strategy. But if selling and putting the equity into the next house puts them into a stronger financial position, we can also advise them on that as well. You see, the objective isn't just to protect your old mortgage at all costs, and it isn't just to sell you a home because you want another one. My objective is to help you figure out which combination gives you the best overall financial and lifestyle outcome. Therefore, I want to walk you through all the options and, more importantly, the numbers I think you need to know when making that decision. Okay, do you need to actually sell? Before we answer this question, let's start with the question I usually ask first. Do you need the equity in your current house in order to buy the next one? If the answer is no, you have a lot of flexibility. You can sell, you can keep the property as a rental, you may even be able to buy the next house before making a final decision on the old one. But for most homeowners that I work with, they have a substantial portion of their net worth sitting inside their current house. So they may have as much as $200,000 to $300,000 or considerably more in equity, but that money isn't sitting in their checking account. It's trapped inside the property until they either sell the house or borrow against it. And that's an important distinction because needing the equity doesn't automatically mean you have to sell. If you're sitting on substantial equity, another option may be to access some of it while the property is still your primary residence. One way of doing that can be through a home equity line of credit or a HELOC. Depending upon your financial situation and the terms available to you, you may be able to establish that line while the home is still your primary residence and then use part of that equity towards the purchase of your new home. That potential allows you to accomplish two very important things. Keep the existing property and its existing first mortgage while also accessing some of the capital you accumulated inside. This can be a very powerful strategy, but only if we account for the costs correctly, because the equity that you borrow isn't free money, it's debt. Suppose you have $300,000 in equity and want to access $100,000 of it for the purchase of your next house. You haven't magically created another $100,000. You've moved $100,000 of equity out of one asset and replaced it with a $100,000 liability. And now that liability has a payment. That payment matters on both sides of the decision. If you keep the house, does it actually work as a rental? This is where my property management side and my own personal investing come into the conversation. People will say, my mortgage is $2,000 a month and I can rent my house out for $3,000. Why would I ever sell it? And maybe you shouldn't, but that's not enough information. If you're going to keep the house, I want you to know what it actually costs to own. You need to account for the mortgage, the property taxes, the insurance, HOA, if there is one, maintenance, vacancy, capital expenditures, management, if you're not going to manage it yourself. And if you borrowed against the property to help buy the next house, we need to also add the cost of that debt service. Maybe the property rents for $3,500 a month and your existing housing costs are $2,200. At first glance, that looks great. But if accessing the equity adds another several $100s a month, suddenly the economics look a little bit different. Then account for maintenance and vacancy. Maybe it's still a great rental, Maybe it's barely breaking even. Maybe you're now having to subsidize it every month. None of those outcomes automatically means you shouldn't keep it as a rental, but you need to know which one you're choosing and why, because there's also an opportunity cost. If selling the house gives you an additional $250,000 that you could have put into the next property, what that does to your new mortgage payment. And how does that compare against the old house payment and potentially borrowing against it and carrying two debts on both properties? That's the comparison I care about. Not simply, can I rent out my house for more than my mortgage? The better question is, does keeping this improve my overall financial position after I count for all of the costs? If it does, keeping it may be a fantastic option. If it doesn't, a 3% mortgage by itself isn't a good enough reason to turn a house into a rental. If you sell, what do you actually walk away with? Now let's look at the other side of the situation. Maybe keeping the house doesn't work. Maybe you simply don't want to be a landlord. Then we need to figure out what selling actually gives you. This is where a lot of people's math suddenly falls apart. Let's say your house is worth $675,000. You don't have $675,000 minus your mortgage available to go into the next house. You still have to sell it. As a planning number, I generally want my sellers accounting for somewhere around the neighborhood of 6 to 8% of the sales price for the total cost of selling. That can include commissions, title and closing costs, buyer concessions, inspection items, and the work that you potentially need to do to the property before it comes on the market. On a $675,000 house, 6% is $40,500. 8% is $54,000. Then we need to pay off the mortgage, and what's left is your approximate net. That's why I don't want someone building their next purchase around the Zestimate or another automated valuation. Those give you a gross number. Your next house is being purchased with a net number. And the difference can be easily tens of thousands of dollars. So don't just ask, what's my house worth? Ask, what am I actually likely to walk away with? Now we have a number that we can actually use. What does your equity actually buy you? This is where I want to connect your equity to your next payment. Everybody tells me their interest rate. Almost no one tells me their payment. And if you're trying to figure out whether you can move, I'd rather know your payment. One of the questions I hear all the time is, how much equity do I need to move up without dramatically increasing my payment? There's no percentage to answer that. It's arithmetic. Let's say you're selling your current house and you actually net $250,000. And let's say your current principal and interest payment is around $1,900 a month. At roughly 6.5% mortgage, $1,900 supports a loan amount of roughly $300,000. Add the $250,000 that you're putting down. Now you've got roughly a $550,000 purchase price with principal and interest as to where it is today. Now let's change the financing. Maybe mortgage rates fall. Maybe the ARM makes sense. Maybe the house you're buying has been sitting on the market, and instead of negotiating another $15,000 off the purchase price, we negotiate with the seller concessions so you can use that money on a temporary or a permanent rate buy down. There's multiple levers available to us. Take roughly a full point off the rate in that example, and that same $1,900 a month payment supports around $334,000 instead of $300,000. Now your purchase price is closer to $584,000. That's a meaningful number, but the interest rate isn't the only lever. The payment you're willing to carry matters enormously. Maybe keeping the exact same payment isn't actually your objective. Your income may be considerably higher than when you bought your current house. Maybe you're comfortable increasing your principal and interest from $1,900 to $2,300 because a new home solves something important for your family. Now the math changes again. This is why I don't think you should start with rates are 6.5%, so I'm not moving. Start with, what payment am I comfortable with carrying and how much capital do I have available? And what purchase price does that combination support? That's a much better conversation. Don't assume your equity will solve the problem later. There's another reason why I want people to actually run these numbers instead of simply waiting. Nationally, homeowners are sitting on enormous amounts of equity. Cotality, formerly CoreLogic, recently reported that the average homeowner with a mortgage has roughly $310,000 in equity. But that's an average. Your situation depends heavily on when you bought and what you bought. Someone who bought a detached house in the Denver Boulder corridor in 2018 or 2019 could be sitting in a completely different position than someone who bought a condo or townhome near the peak of 21 or 22. Those aren't the same market. And we've also moved into a much flatter appreciation environment than people have been accustomed to even just a few years ago. That doesn't mean that values are collapsing. It means that waiting another year doesn't guarantee your equity position improves enough to offset whatever happens with rates, prices, or the house you want to buy. Your house doesn't know you're waiting for mortgage rates to fall. So instead of assuming that the market will eventually solve the problem for you, I would rather you know what your equity can actually do for you today. Should you give up a 3% mortgage? Now we can finally talk about the question that everyone wants answered. I've got a 3% mortgage. I'd be stupid to sell. I put it differently. You'd be stupid to give up a 3% mortgage for no good reason. That's not the same thing. A 3% mortgage is incredibly valuable. And if you can keep that loan and turn the house into a strong rental, access the capital you need at a reasonable cost, and comfortably afford the next property, that's something I would want to explore with you. But don't just keep a property that doesn't make financial sense simply because of the first mortgage has a great interest rate. And don't stay in a house longer than works for your life solely because you're afraid of giving up that loan. A mortgage is a financial instrument. The house is where you're actually living your life. So quantify what the move solves. Suppose moving increases your total house payment by $400 a month. That's $4,800 a year. But what if that move cuts 40 minutes out of every day in your commute? You're potentially reclaiming around 200 hours of your life every year. Now we have a trade off worth evaluating. Maybe you're moving for a school district and your child is 8 years left in the system. Maybe you need another bedroom. Maybe you're moving to be closer to family. Maybe you're downsizing and getting rid of a house and a yard you no longer want to maintain. These things have value. But if you're paying $800 a month to essentially own a home and a house that's in a different zip code, that's a much harder argument for me to make sense. So don't just ask, what am I giving up? Ask, what am I getting in return? And if you're buying materially a better life for the next decade, or are you just buying a different address? Now decide how you're going to structure the move. Once we've decided that moving makes sense, we still have to figure out how to get you from house A to house B. And there isn't just one way to do it. Option one, sell first. This is financially the cleanest. You're selling your existing house. You know exactly what you net. You know exactly how much money you have available for the next purchase or not carrying two mortgages. And when you write an offer, you don't have another property that still needs to sell. The downside is the housing gap. What happens if you sell on a Tuesday and don't find the next house for another 3 months? That's a real consideration, but there's ways to address it. We might be able to get you a post occupancy agreement. We can try to coordinate the transactions to close on the same day, or temporary housing may make a lot of sense. The other option is to buy first. And if your financial position allows for it, you can buy the next house first. You don't have to have that housing gap I mentioned earlier. You find the house you want, you buy it, you move into it, and then you sell the old house. That can be a much easier physical move, but financially, you're taking more of the risk. You may temporarily carry two payments. And once you own the second house, the urgency around selling the first one suddenly changes. When you've sold the house before buying, you can say, let's wait for the right offer. After buying, two mortgage payments can start to say, we need to get this house sold. That's leverage you handed to the buyer. The third option is what we talked about earlier. Access some of the equity, potentially through a HELOC. Use that capital towards the next purchase and retain the old house as a rental. This can be an excellent wealth building strategy when it comes to the rental economics that support it. But remember, you're not just keeping the old mortgage, you're potentially adding another debt payment to it. So we have to evaluate the old house and the new house together with the HELOC. Option four, use short term financing to bridge the transactions. Depending upon your financial situation, bridge financing or other lending strategies may allow you to purchase before the sale closes and then pay down or restructure the new mortgage after receiving the proceeds. Maybe that involves a bridge loan. Maybe it involves a HELOC. Maybe it involves recasting the new mortgage after the old home sells and you roll that equity into that. The exact financing structure is something I want you working through with a good lender because the cost, qualification requirements, and risks matter. But the important point is that you have options beyond simply just selling your house and hoping the timing works. Bottom line, if you own a home and you're thinking about buying another one, don't start with, what's today's interest rate? And don't automatically start with, I could never give up my 3% mortgage. Start with the entire balance sheet. What is your currently house worth realistically? What do you owe? What could you sell it for? What would you actually net? If you kept it, what would you realistically rent it out for? What does it cost to operate it as a rental? If you need to access the equity, what does that money cost you? What payment are you comfortable with carrying on the next house? And most importantly, what is the move actually accomplishing? Once you know these things, we can compare those options honestly. Maybe you sell, take the equity and put it into the next house. Maybe you keep the property as a rental and use a HELOC to access part of that equity. Maybe you buy first and sell afterwards. Maybe you sell first and negotiate time to stay in the house while you find the next one. Maybe we use a seller concession, a rate buy down, an ARM, bridge financing, or a mortgage recast to make the numbers work differently. There isn't one strategy that is right for everyone. The right strategy is the one that gives you the best overall financial position while accomplishing the reason you wanted to move in the first place. And that's the work I want done before you start touring houses. Because once you find a house you love, it's very easy to start manipulating the numbers to justify a decision you may already want to make. I'd rather you do the opposite. Build the financial strategy first. Go find the house that fits inside it. And if you're considering selling or buying in the greater Denver Boulder market, I've linked my selling process guide and buying process guide below. Those walk you through the sides of the transaction that can help you start thinking through which of these options make the most sense before you're trying to manage a sale, a purchase, and potentially two mortgages all at the same time. Until next time.